Okay, so chapter 2, we'll be looking at, let me welcome us again formally to the call, even though we are few, I believe others will join as we continue. So we'll be looking at the regulatory environment today. We looked at the need for audit and assurance in the first chapter, and we also looked at some scenarios that will help us grasp the concept and some cases. Also in this regulatory environment, we'll be looking at cases after each section, and so pay attention to the cases. They will help you understand the subject of the case study text very practically. All right, so the competencies, laws and regulations, and also ethical issues are necessary for AAA candidates in the AAA exams, and not just the exams, passing the exams, but also how to apply this in practice, especially for those accountants in practice. You run an audit firm, or you work in business as an internal auditor, or in the forensic investigation space, fraud investigation, any space you work in that has to do with verification and checks and investigations. You really need this regulatory environment to help you understand practically how to navigate the regulatory environment and the auditing space. So some of the competencies that will be needed is you should be able to advise on technical, professional, and ethical issues that may arise during assurance engagements in the public and the private sectors, including evaluation and communication with any party to the engagement. So it's very important that these competencies are taken note of, because the examiner in his questions mostly tests this chapter 2. Chapter 2 is a bit bulky, is voluminous. We may not be able to exhaust all the detail in today's class, but then we need to take it bit by bit so that you'll be able to address the questions the examiner brings our way very, very objectively, practically, and with the valuable points that will give you your marks in the exam. This is very important. So looking at the first competency on advice on technical and professional ethical issues, you should be able to talk about independence and objectivity. You must understand that your technical and professional and ethical competency matters here. You should be able to, as an auditor, talk about or show your independence and objectivity, display it practically. You must remain unbiased when evaluating financial statements. This is very important. Another technical competency or professional and ethical is the area of conflict of interest. You must avoid situations that compromise professional judgment. So that's one of the technical professional competency you must display. Also confidentiality. I know we've talked about this maybe in advanced audit and assurance and other subjects, maybe the early part of case study, but then it brings to bear very clearly here in the AAA subject. Confidentiality is ensuring client information is not disclosed without consent or permission from the client. Also, another technical and professional competency is professional skepticism. Means maintaining a questioning mindset to detect fraud and misstatements. This is very important for auditors. And also another technical professional competency is communication with stakeholders, report findings to management, audit committees, regulators like the FRCN, CAMA, and every other external regulator you are obliged to report to. Also shareholders, and reporting in a clear and ethical manner. So these are the competencies you need as an auditor and what to expect in the exams to be able to pass the AAA subject. Number 2, we're looking at the competencies needed is to identify and explain the nature and purpose of laws, regulations, standards, and codes in the context of assurance engagement. The purpose of laws, regulations, standards, and codes of assurance engagement involves ensuring transparency reliability and accountability in financial reporting. This is very important. Key frameworks like the International Standards of Auditing, that is the guidelines for auditors, the ICAN Code of Ethics, which helps us with the ethical principles for Nigerian accountants, and the Company and Allied Matters Act, which is the CAMA, is the legal framework for corporate governance in Nigeria. Then the Financial Reporting Council Act regulates financial reporting and auditing standards. So in this second competency framework or requirement, you should be able to identify and explain the nature and purpose of laws and regulations, standards and code in the context of assurance engagement. This is very important. Take note of it. The third one is you should be able to evaluate, explain, and communicate the process and issues involved in standards setting process, both at national and international levels. Standard setting processes, both international and national levels, involves bodies like the International Standard Setting Board. International setting bodies like International Auditing and Assurance Standard Board. They issue the international standards on audits. So they are called the IAASB, International Auditing and Assurance Standard Boards. So that committee or that body issue out international standards on auditing, which we call ISAs. Another international standard setting body includes the IFAC, the International Federation of Accountants. They oversee globally ethical standards. Then the next body is the International Accounting Standards Board, who develops IFRS, International Financial Reporting Standards. These three, the IASB, the IFAC, and the IASB, are the international standard setting boards that provides the standard setting process. Then we have national bodies in Nigeria like Financial Reporting Council of Nigeria. They adopt and enforce the international standards on auditing and the international financial reporting standards locally. So their job is to enforce it in Nigeria. Then we have bodies like ICAN and ANAN, professional bodies that ensure compliance. So the standard setting process is very important to take note and how to explain them when it's presented at the exams. Number 4, competency you should be able to garner is to be able to evaluate and communicate the interactions between national laws and regulations and the requirements of assurance engagement. Now, in looking at the international or interactions between national laws and assurance engagement, regulatory compliance is mandatory. Auditors must ensure financial statements align with national regulations. We've spoken about that, the CAMA, the FRCN Act. Conflict between international and local laws. Nigerian firms may face challenges reconciling IFRS with tax laws. So these challenges will help us to navigate the auditing space and look for solutions to tax laws. There are no IFRSs covering tax in Nigeria, so the SARS or the Nigerian Accounting Standard Board still come to play when it comes to administration of tax laws. Also, regulatory oversights, authorities like the same FRCN and the Securities and Exchange Commission monitors audit firms to ensure compliance. So take note of this 4th competency, and the 5th and final one is the evaluation and communication of the differences between various jurisdictions and how they deal with audit issues, including national, international approaches, looking at the rule-based, the principle-based. The rule-based aligns more with the US and the introduction of the Sarbanes-Oxley Act and related requirements. So this is important because the differences in jurisdiction between the UK and the US, if you look at Nigeria versus the international practices, Nigeria follows ISAs, IFRS, and ICAN guidelines, while the US uses GAAP, which is the generally accepted or acceptable accounting principles, and is heavily influenced by Sarbanes-Oxley Act, which enforces strict audit regulations. You'll see that the UK follows the FRC and the IAASB standards with an emphasis on auditor independence. So these two jurisdictions, the US and the UK, the US, you see that the Sarbanes-Oxley Act was established after the collapse of Enron and WorldCom, those notable scandals. The establishment of the Sarbanes-Oxley Act was for the purpose of strengthening audit oversight. There was also the creation of Public Company Accounting Oversight Board in the US to regulate auditors. The PCAOB came about after the Enron and WorldCom scandals. Also, the Sarbanes-Oxley Act also provides a requirement for CEOs and CFO certifications and signatures and sign-off of financial statements. So this fifth competency, we'll be looking at it in detail as we move on in the study or the discussion and deliberation we have. So it's important that students, candidates sitting for the exams understand the regulatory environment that surrounds various industries of the nation's economy. This chapter provides details of that environment. You'll be able to learn about the need for regulation of audit and assurance services, and also the background of professional standards, including the standards setting process. You also learn the concepts of corporate governance in an audit setting, and also the definition of and duties of an auditor with respect to money laundering. So this chapter 2 with details of the requirement of the International Standards on Auditing 250. At the end of this chapter, you should be able to explain the need for regulation of audit and assurance services. Also, explain the process of appointment, resignation, and removal of auditors. Describe the eligibility, rights, and duties of an auditor. Describe the role and structure of professional standards, including the standard setting process. Also summarize the key features of corporate governance in relation to audits. Then explain what money laundering is, and summarize the obligations and duties this places on an auditor. And finally, be able to apply ISA 250 to the audit of financial statements. So this study text, as we are going into the module or the chapter, very detailed. You should be able to harness this, and we'll test it with a chapter review and a 5-question OBJ test to see if you really follow. So I hope you pay rapt attention, and please engage where you have a question or comment or observation. Please be free to interject. Raise your hand, and I would like to hear your thoughts on the subject. It will also help you so that you don't sleep. So engage, ask questions, let's interact. Yesterday was nice, and the case study, at least we're able to solve questions together. So let's make this one interactive also, because I'll be providing cases on each unit that has happened and how it resonates practically with the study text. Okay, so this is our outline. We're looking at chapter 2 or module 2, the regulatory environment. So the first unit will be looking at the need for regulation of audit and assurance. The second unit will be looking at professional standards. The third unit, corporate governance. The fourth unit, money laundering. The fifth unit, consideration of laws and regulations in an audit of financial statements, which is International Standards of Auditing 250. And we'll round up the chapter. Okay, so we'll look at Unit 1 and the sections. There are sections in Unit 1. Okay, so the first unit is the need for regulation of audit and assurance. Now, the first section under the need for the regulation of audit and assurance is the public interest. So there's a need to regulate audit and assurance service in the public interest. The public are always victims of circumstances, especially where you have collapse of companies where investors have injected funds. No matter how little maybe your money is in a public limited company bank, if that bank collapses, it affects you. So there's a need to regulate audit to help foster trust and confidence in the public interest. This is very important. So that's the first section, or the first item on this unit we'll be looking at. Okay, so let's look at the public interest. Now, the key reason why audit and assurance services should be regulated is to serve the public interest. So auditors, internal and external, are there based on the third line of defense model provided by the Institute of Internal Auditors. The internal audit and the external audit is the third line of defense. What are you defending? You are defending the public. You are defending the company against attacks. And that is why the external audit comes under heavy scrutiny, and the internal audits when there are corporate collapse or crashes of companies. The first question people will ask is, where are the auditors? Where are the auditors? When money is being siphoned, when funds are looted, when processes are not followed. So as auditors, we are chartered accountants, but you have that audit cap. You always wear that audit cap. You have that responsibility to protect the public. This is very important. So the key reason for audit and assurance services and the regulation of the same is to serve the public interest. Assurance providers should give an impartial, professional view on issues that matter to the users of financial statements and other non-financial information. So it's very important that this can be viewed and trusted. So the public should be able to trust that auditors, chartered accountants are protecting them. So you should be able to flag where there are issues in financial statements, tell management that this is wrong, and that's the essence of auditing and assurance services. So assurance provides need to operate within ethical boundaries. So company directors, management should operate within ethical boundaries. It's very important. When you look at the cases of corporate collapse, we'll be looking at some that will resonate and align graphically with what we're talking about. You'll see that a lot of them took laws into their hands, suppressed auditors, and caused corporate collapses, which made the public lose interest, and most of them, their investments at the same time. So assurance providers need to operate within ethical boundaries to consistent standards also. So that's the reason. You know from your previous studies that assurance providers are regulated by the law of the land in which they operate. So there are laws of the land. Even before the coming of international standards of auditing, we have our own local laws. So we need to operate within the laws of the land, and auditors, that's our job to enforce that. Also, the ethical standards of the land and the professional body to which we belong, for example, ICAN. Also, the professional standards adopted by their country, for example, the international standards of auditing. So before the international standards of auditing adoption by Nigeria, we had the Nigerian standard of auditing formally. We had our own financial reporting framework before the adoption of IFRS in 2012, 2013. We had SARS, Statement of Accounting Standards, issued by the Nigerian Accounting Standard Boards. So the public interest is what these standards are all about, to protect the public interest. This is very important. So this laws of the land and the adoption of international laws is all about the public interest. It's all about the public interest. So take note of it. The public interest is the essence of every law promulgated and provided in the auditing space to help defend the public. Very important. Okay, so there's a case, I've spoken about it in chapter 1. There's a case in chapter 1 talking about a short scenario. I spoke about it in Cadbury, the Cadbury Nigerian accounting scandal in 2006. Cadbury Nigeria PLC, one of the country's leading confectionery company, faced a major corporate scandal in 2006. We spoke about it, but it graphically applies here. When their financial statements were found to have been misrepresented, the company overstated its financial performance over several years through improper income recognition, that's revenue recognition, and inflated stock values. When the irregularities were discovered, Cadbury Nigeria had to restate its financial statements, causing a significant loss to investor confidence. So you can see the need for public interest here and how this affected the public that have invested in that company by buying shares or providing debt capital to that entity. Now, the relevance of this case to public interest regulation is you understand ethical boundaries like we spoke about. Auditors are expected to follow ethical principles such as integrity, objectivity, professional skepticism. So in this Cadbury case, you see that external auditors face scrutiny. The auditors were PwC over whether they performed adequate due diligence to detect fraud. You also look at the study text, we looking at consistency of standards. You can see to consistent standards, assurance providers need to operate within or in consistency of the standards that are regulating the profession. Nigeria operates under the Financial Reporting Council and follows IFRSs. So the Cadbury scandal reinforced the importance of strict adherence to accounting and auditing standards. Also, the regulatory action after that case was the scandal led to increased scrutiny of auditors in Nigeria, reinforcing the need for regulatory oversight and stricter enforcement of international standards on auditing, the ISAs. So that case brought to bear a lot of things and strengthened the regulatory framework in the interest of the public. This is very important. So take note of that case, and you can also read it online and glean more on what transpired. Okay, so we can look at a global case. That's a local case in Nigeria. A global case that is known, talking about the Enron scandal in 2001 in the US. Enron Corporation, was once one of the largest energy companies in the US. It collapsed due to massive accounting fraud. The company used complex financial instruments and off-balance sheet entities to hide debt and inflate earnings. When the fraud was discovered, it led to one of the biggest corporate bankruptcies in history. And that's where we find the relevance to regulate the accountancy and audit space to the public interest. So we had legal and ethical violations like we saw in the example. The auditors at Anderson LLP that time then were accused of failing to exercise due diligence in their audit procedures and were complicit in concealing the fraud. So auditors were always under fire when it comes to any issue of corporate scandal or collapse. And this raised concern about auditors' independence and professional integrity. So as chartered accountants, please take note of this. That was a global case that shook the world. And the regulatory response, the scandal led to the introduction of Sarbanes-Oxley Act in 2002. which strengthened financial reporting standards and established the Public Company Accounting Oversight Board to regulate auditors, all in the interest of the public. So international best practices based on this case demonstrated the need for independent audit oversight and adherence to international standards on auditing. It also led to global regulatory changes influencing the way audits are conducted worldwide. So that case was a massive shake-up. It shaped the audit space and the world. And it's very important that we bear in mind that the public interest is our priority when it comes to protection of public wealth. So what are the key takeaways from these two cases in alignment with what we are just, this short section on the public interest? Both cases, the local and the Enron, emphasize the critical role of audit regulation in serving the public interest by ensuring that financial statements are reliable, transparent, and free from manipulation. So that's a key takeaway. Take note of that. Regulatory bodies like the Financial Reporting Council of Nigeria, the Public Company Accounting Oversight Board in the US, and the International Accounting and Auditing Standards Board globally set professional standards to maintain public trust in financial reporting. So ethical conduct, legal compliance, and adherence to ISAs are essential to prevent corporate failures and protect stakeholders, including investors, employees, and the economy from collapse. So these cases highlight the necessity of robust auditing frameworks to uphold public confidence in corporate financial reporting. So this is very important. So take note of that. In the public interest, we need to ensure that standards are followed and ethical boundaries are enforced, and we have smooth running of corporations in the public interest. So take note of that. Okay, so that will be the end of the first section on the public interest. Do we have any questions, observations, or comments so that we'll move to the ethical regulation aspect? Any questions? Any comment, any observation? I hope we are all following. I hope nobody is sleeping.
None from me, sir.
Okay, fantastic. All right, I believe we are all following. Okay, we are 4 on the call. Okay, that's good. All right, so let's move to the next section, which is the need for ethical regulation. We've looked at the public interest, and the other one is the need for regulation of audit and assurance services, and ethical regulation is the second section. Okay, so assurance providers are given ethical guidance by professional bodies like ICAN, which all of us belong to. So you are students, I'm an associate, very soon you'll be associates. And we also have lawyers, the National Bar Association. We have International Federation of Accountants. We have ICAN, a member of IFAC. ACCA is a member of IFAC. ICAW is a member of IFAC. Most of the professional accounting bodies are members of IFAC, including ANAN. ANAN are also a member of IFAC. So this ethical regulation is enforced by these organizations that belong to accountancy like ICAN, the Nigerian Bar Association, which is the law body that enforces compliance, brings up members, and regulates the profession in law. Then the global body that monitors and provides oversight over these bodies, the IFAC. And you should be already familiar with most of the ethical guidance relevant to the syllabus from your earlier studies, which is revised in chapter 3. So we'll be looking at the ethical regulation more in chapter 3. So the ethical regulation is necessary when you look at case scenarios in Nigeria. So for example, the Institute of Chartered Accountants in regulating auditing in Nigeria plays a very significant role in establishing ethical guidelines for its members. And most of the curriculum on auditing, case study, and most of the study texts incorporates these ethical values in the teaching curriculum to help impact students to understand what it takes to thrive in the business space and how to work, how to behave. What enhances our professional behavior are embedded in these trainings we go through. And at the end of your exam, don't forget you still continue your program of education, which is called Mandatory Continuous Program of Education, which is MCPEs. And you must have minimum credit hours of 40. So that you pass ICAN exam does not end there. It doesn't end at just passing the exam, collect certificate. You have to keep updating that certificate on a yearly basis. Last year, I had 67 credit units. So I exceeded the 40 that is required. The minimum is 40. Last year, I had 67. So the mandatory continuous program of education are structured and unstructured programs where you have to sit down and learn. Though you may not write exams, but it's like a way of updating you. So the ethical regulation of the auditing space, ICAN plays a very, very pivotal role. And that is why it's a leading body, because after passing your exams, you still continue learning to stay updated in the field. And this is to ensure auditors adhere to rigorous standards. ICAN emphasizes the importance of maintaining objectivity, independence, transparency while performing audits, which is aligned with the best practices in the auditing field. So continuous learning cannot be overemphasized to ensure we are ethically up to date and fit for the profession. The wise man Henry Ford used to say, the day you stop learning, you start dying. Not dying physically, but dying mentally and in your field. So on a daily basis, you need to keep learning. You need to keep learning. So in auditing, it's the same. Keep yourself abreast of the facts happening in that industry. It's good we'll pass our exams, but then beyond passing, the value we add, we bring to wherever we find ourselves is very important. So what are the relevance to the ethical regulation in the need for assurance? You see that the need to regulate ethically helps us enforce compliance through disciplinary actions and continues to educate members about ethical conduct, helping them navigate complex scenarios and situations in auditing and assurance services. So this is very important. So the relevance of ethical regulation is to help us navigate business issues, ethical dilemmas, and how to resolve them amicably. Now, there's a global case between KPMG and Carillon in the UK in 2018. The case is verifiable. Carillon, a major UK construction company, collapsed in 2018 due to financial mismanagement and accounting irregularities. KPMG, one of the big four, the company's external auditor, was accused of failing to identify serious financial risks in the audit reports. So the Financial Reporting Council of UK found that KPMG auditors breached ethical standards. You see the ethical regulation now we are talking about, by lacking independence and failing to challenge Carillon's financial statements properly. So if you look at this global case between KPMG and Carillon, you will see that the first relevance is failure in professional skepticism. KPMG auditors did not critically assess Carillon's reported financial health, violating IFAC's fundamental principles of integrity and objectivity. So this is very important. Take note of these cases. Also, the relevance is the legal consequences. The UK Financial Reporting Council imposed disciplinary actions, and regulatory reforms to prevent similar audit failures in the future. Also, another relevance is the strengthening of ethical guidelines. This case emphasized the importance of ethical compliance in auditing, reinforcing the need for independent regulatory oversight and stronger enforcement of ethical standards. So the need for regulation, or the regulatory environment in the area of ethical regulation, you can take away some of these ethical regulations are critical to maintaining trust in financial reporting and ensuring that auditors act independently and with integrity. So national bodies like ICAN, IFAC, and the Financial Reporting Council plays crucial roles in setting and enforcing ethical standards. Regulatory intervention in both cases, you can see the ICAN coming in, the FRC in the UK, demonstrates the importance of ethical compliance in auditing, ensures that firms adhere to professional codes of conduct and global best practices. So the ICAN regulating ethical conduct, and this case we just saw, illustrates why ethical regulation is necessary to protect stakeholders, uphold public trust, and maintain the credibility of the audit and assurance profession. So this is very, very important. Okay, so we've just spoken to the ethical regulation section. Do we have any questions on that? Any comment, any observation, so that we can move to the legal regulation in the need for regulation of audit and assurance services? Any comment, any question? Okay, fantastic. Thanks for that feedback. All right, let's move to the legal regulation. The legal regulation. So take note of this chapter. The examiner normally comes in this aspect. So let's take our time and discuss this so that you'll be able to attempt any of our mock exams in this chapter 2. I assure you he tests this regulatory environment frequently. So take note of this chapter and the units we are looking at. Okay, so the legal regulation. Most countries have legal requirements associated with some assurance providers, particularly auditors. Examples of these legal requirements in Nigeria can be found, for example, in ICAN Act. ICAN Act came in 1965. We have the CAMA Act updated. We have 1990, but the latest is 2020 updated. And we have the BOFIA, which is Bank and Other Financial Institutions Act 1991. And we also have the Insurance Act. So, like Nigeria have these legal requirements provided by these legal authorities. So the legal foundation is to help provide a framework and a pathway for auditors to be able to drive and work very, very seamlessly. So these bodies, you know about them, the ICAN, the CAMA, the BOFIA, the Insurance Act. They are guidelines that helps you provide your professional judgment when it comes to working in the audit and accounting space. So legal regulation is very important because it provides us with a framework on how to work and the laws and the rules to be able to play the game. This is very important. So there's a short case scenario on the legal regulation of auditing. There's a local one and a global one. I'll just provide a little context on them. So there's the local case in Nigeria between Ernst & Young. EY is one of the big four, and First Bank of Nigeria. So that case was in 2021. The Financial Reporting Council imposed sanctions on EY for failing to comply with legal and regulatory requirements while auditing their client, First Bank of Nigeria. The case involved EY's inadequate assessment of loan impairments. So violating the CAMA 2020 and BOFIA 1991 led to those sanctions from the Financial Reporting Council of Nigeria. The relevance to, looking at that short case, the relevance to legal regulation is the non-compliance with this CAMA 2020 and BOFIA we looked at. The failure of EY to follow regulatory requirements concerning financial disclosures, leading to misstatements in First Bank's financial report, was one of the reasons for the sanctions. Also, the regulatory enforcement, the fine imposed on EY is to reinforce that audit firms must comply with legal standards in Nigeria. That is just it. You can't flaunt Nigerian laws and go scot-free. So the FRC has come to instill discipline and fear, just like you see it applicable in the UK, the US, to keep auditors on check and on their feet. Also, you see that the case between this EY and First Bank highlighted the importance of strict adherence to audit regulations, legal regulations, to ensure transparency and maintain public confidence. This is very important. Okay, so there's also a case of the Colonial Bank in the US in 2017 versus PwC. PwC were their external auditors. This case happened in 2017. PwC were fined about $625 million for its failure to detect a 2.3 billion fraud in Colonial Bank. Wow, 625 million. PwC was fined because they failed to detect a $2.3 billion fraud at Colonial Bank. Colonial Bank was a US financial institution PwC audited. PwC was found to have violated legal and professional standards, particularly the Sarbanes-Oxley Act of 2002 we spoke about. Sarbanes-Oxley Act governs financial reporting and auditing in the US. So what is the relevance to legal regulation of this case? You see that the breach of the Sarbanes-Oxley Act, PwC did not perform sufficient audit procedures to detect fraud. And that was the breach that was committed, violating legal provisions aiming to prevent financial misstatements. So it's very relevant, and the regulatory action were that the US regulators and courts imposed fines and severe penalties, reinforcing the importance of legal frameworks in auditing and checks, and also the need for stronger oversight. The case led to stricter audit quality reviews, emphasizing the critical role of legal regulation in ensuring auditor accountability. So everybody must be brought to the book, even the auditors. They used to ask me in the office that who audits the auditor? And I tell them, well, the external auditors audit the auditor, and also there are other frameworks that audits the auditor. So the auditor is not on his own. If anything goes wrong, he will be first sanctioned. So take note of that. And the key takeaways is that legal frameworks such as CAMA, BOFIA, and in the US, the Sarbanes-Oxley Act are essential for maintaining audit quality and financial transparency. So regulators like the FRCN, the PCAOB in the US plays a crucial role in enforcing audit laws and holding auditors accountable. Legal regulation ensures that auditors maintain the independence, exercise due diligence, and provide reliable assurance services to protect the public interest. So these two cases, you will see that it demonstrates the importance of legal compliance in auditing and the consequences of violating established regulatory standards. So this is very, very key. Okay, so before we move to, do we have any questions on the legal regulations? We've looked at 3, the need for regulation of audit and assurance services. Do we have any questions so that we can go on break? This is 8:50 or 8:51. My watch says 8:51. So that we can go on a 10 minutes break, remove our eyes from the screen, just stretch and come back by 9 p.m. to continue. Is that okay with us?
Yeah.
All right. Even your voice sounds low. The way you said, yeah, you sound tired.
So, sir,
Yeah, sorry.
like these
Yes.
companies now, like the PwC that was sanctioned, the EY,
Mm.
how do I put this English now? It will reduce because of their mistakes, because I want to turn it as mistakes. It will reduce the confidence the public have in those companies. And do they still like have the license to carry on um audit work for other companies, or this
Yes.
the sanction permanent or something like I think I'm asking
Okay,
two in one
so
question.
yes. So I'll take the first one. The first one is it will not lose the public confidence because these guys have been auditing a lot of companies. So where you found one or two wanting, you sanction them based on those wanting. Because the other good they've done also, you should be able to give them credit for that. Now, these companies we mentioned are most of the big four audit firms. We've not even talked about the medium size, then the small audit firms that are co and co and co and co. Now we emphasize the big four. Those are the records we could find online that are verifiable. So those cases that happen that I've spoken to or have brought to bear here are the cases they sanction them for. So those fines and penalties are one-off. They are not ongoing. It's not that they should stop providing audit services. Of course, KPMG, EY, Deloitte, and PwC are still in the audit space today. They still work globally. Like in my office, PwC audits us currently. So,
Yeah, I
in
know
answering your
PwC works in
questions,
Nigeria, but okay.
yeah, so in answering your question, no, the penalty does not stop them from providing services. It just that case that is at hand or that was mentioned, they penalize them for that, they pay the fine, and they continue. So it serves as a deterrent to make sure you are careful in auditing companies. But most of the time, you see that their audits are always high quality. Like currently, they are
Yeah,
auditing us, and man, they are very, very stubborn guys. They will not give up. They will turn over the
they're thorough.
books, ask you this, ask you that. They are so stubborn.
Hmm.
So their work, I would say, is of quality. So they are doing well. But where you say, like, let me borrow your words, mistake, where they make mistakes, they actually pay heavily for it. Because the FRC in the UK and the US and even Nigeria currently, once there is a corporate collapse, man, the regulators don't play. They make sure they carry the sledgehammer and hit it on those auditors. So that's the essence. I hope I was able to provide
Interesting.
some
Yeah,
answers to
sure.
your question.
Yeah,
Okay,
thank you, sir.
okay. All right. I love your questions. They are very nice. Anybody else with these same kind of questions? I like them. Bring them on. They are good questions. Because today we had a meeting with PwC and what they were asking, man, these are young auditors, but they'll be asking questions that you'll be wondering, what is this now? These things are simple. Look at the ledger, look at this, reconcile it. They tell you it doesn't tally, it's part of their job anyway. So it's good so that the FRC doesn't sanction them if there is a corporate collapse. Yeah. Okay, any other questions so that we just go on break?